So good evening. On behalf of the New York Technology Council, we're really pleased to welcome you here for this event, Crowdfunding Debrief. For tonight, we're here as part of the New York Technology Council. For those who don't know, we are an organization dedicated to supporting and promoting the technology industry in New York City. I'd like to start by quickly thanking all of our sponsors. I'm not going to name them all, but here they are all on the screen. We count on them and their support for putting on events like this. So we thank them for their steadfast support of NYTEC. Also, I'd like to just reference quickly our partner organizations. We do a lot of work with these organizations in terms of events and activities in the technology community around town, as well as our media partners, VentureBeat, New York Convergence, and the New York Enterprise Report. Especially this evening, we want to give thanks to the New York Institute of Technology, our host this evening, which provides us with this great space. With that, I'm going to turn it over to Mike Lopez of Eisner-Amper. Mike has really done the lion's share of the work in putting this event together. We thank him for his efforts. And Mike, I leave it to you.
And thank you very much, Paul, for that introduction. And I'd also like to thank all of you for coming out tonight to what we think is going to be a really good event with a lot of good information and a take from some very, very well-known and solid professional people on what the crowdfunding concept, as it's laid out in the legislation, is all about. Just to let you know a little bit about myself, I'm a partner at Eisner-Amper here in New York. For those of you who don't know who Eisner-Amper is, we are a full-service super regional accounting firm. We have offices on the East Coast between here and Philadelphia. And we just recently expanded our presence. We now have a 100-person office out in San Francisco, and we look forward to expanding our knowledge base out there and working with the people out in San Francisco and in Silicon Valley. Just so you know, as a large firm, and myself in particular, we have a really strong focus on the emerging technology space, and it's really, it's really great to be. I mean, I've been doing this a long time, and it's really, really great to be a part of this community in New York. It's absolutely white hot. There's a tremendous amount of activity, at the early stage, and we all believe that this time around it's as opposed to the heydays of the late '90s and the early 2000s, that this is real. It's sustainable, and we're supporting it, and we see a lot of great young companies out there, and hopefully this whole community in New York is going to grow and thrive, and it's really the next great part of the growth of the New York City community. So with that being said, I'd like to get started. First thing I'd like to do is introduce the panelists individually. Let them tell you a little bit about themselves, and then we can get into the talk about crowdfunding. Not only crowdfunding, and I think we're going to expand that a little bit, not get into too deep into the other aspects of the Jobs Act, but I think it's something that goes hand in hand, with what the crowdfunding concept is all about. So, without further ado, our first panelist is to my left here is Scott Wiseman from Atico Capital. Scott, why don't you introduce yourself and tell the people what you're all about?
So my name is Scott Wiseman. Is this on? Is it on now? Is that better? No? How about now? Okay. Atico Capital is a merchant bank, which for those of you who are familiar with what a merchant bank is, it's really a cross between a venture capital fund and an investment bank. So what we do is we invest our own capital, we swap some of our services for equity, and at the appropriate time we raise third-party capital. The firm is about 5 years old. We focus on healthcare, technology, financial services, and the aviation industry. It's kind of a strange practice. Started my career, unfortunately, as a lawyer, practiced for 13 years at one of the large New York City law firms. I was a securities lawyer, and then went on to run several mid-sized investment banking firms. Our focus really is dealing with small companies and looking for companies that understand how to get to be large companies and that are disruptive and that have a definable and defensible position in the marketplace. Thank you.
Okay. Next, we have Alex Fredericks. Alex is a partner at the esteemed accounting firm of Ernst & Young. Alex?
Good evening, everyone. Hope you're surviving the heat out there. As was said, I'm Alex Fredericks. I'm a partner at Ernst & Young. We're a global professional services provider. We do audit, tax, transactions, and advisory. I've been with the firm 17 years, and my current focus is on capital market transactions. I work in our financial accounting advisory practice, where we assist clients with public registrations, whether it's IPO, debt offerings, M&A transactions. So we help a lot with helping our clients understand the complex rules from SEC and go through the life cycle and assist them in getting where they want to be from a funding perspective, whether it be through raising money privately or publicly, and also helping them with the disclosures in the documents, working with pro forma adjustments, working with the requirements that the SEC has, and dealing with also the accounting side. So accounting disclosures, working with the complex rules that the FASB has implemented, making sure that either if we're auditing the company, we make sure that everything is on board there, or if we're working with a non-audit client, making sure we understand that what's in the financial statements is complete and accurate and the disclosures are complete and accurate. So we audit some of the companies and help them with the disclosures, or we can also work with non-audit companies to help them more arms and legs, because if you're auditing a company, certain of the things you're not allowed to do from an independence perspective, and that's big. One things you have to understand from an independence perspective, audit firms can only do so much. So that's why a lot of the companies hire advisors to get them through the process. So that's what I do. I'm not on the audit side of Ernst & Young, which typically a lot of people think of Ernst & Young as a large audit firm, which we are. I work in the capital market space, helping companies like a lot of yours get to where they want to be from a fundraising perspective.
Thank you, Alex. And last, as the curtain rises, we have Sasha Ross, who's a partner at the law firm of Wilson Sonsini Goodrich and Rosati. Sasha.
Hi, everyone, and thanks for coming. So I work for Wilson Sonsini Goodrich and Rosati. For those of you that don't know, we are the premier firm representing technology companies, whether it's two guys and an idea or a large multinational. We as a firm have been involved in most of the transformative technology since probably the HP and Apple days. I started my career in Silicon Valley, took 3 years off to become the employee number 3 of an early stage technology company in India, and returned to New York, where I focus on representing startups and technology companies at all stages of growth, whether it's two guys and an idea or large multinational companies raising money, selling themselves, and pretty much all other aspects of their business, whether it's licensing, things like that.
Thank you, Sasha. All right, so let's talk a little bit about why we are here this evening, which is crowdfunding and the Jobs Act. And I'll start off by giving you my opinion of what I think is going to happen with crowdfunding. Now keep in mind that as one section of the Jobs Act, crowdfunding has not, I mean, the final rules, and I don't know whether you're all aware of this, the final rules and regulations have not even been promulgated at this point. That's not supposed to happen until the end of 2012. All right, so, and I mean, it's a great idea. It's a wonderful concept. There's a tremendous amount of hype with respect to what the crowdfunding concept is supposed to achieve. Now, just out of curiosity, how many of you in the room have your own company or entrepreneurs and are looking to raise capital and would be thinking about possibly, trying to raise money through crowdfunding, right? So that's it's a good piece of the people here. My feeling is that right now it's a lot of hype, okay, and I'm wondering whether or not something like this is really going to work, because I think there are a lot of companies and owners of companies out there that don't understand that there's going to be a tremendous amount of regulation around trying to raise money through the crowdfunding concept. Now, I'm sure you're all familiar with Kickstarter, right? This is not Kickstarter. I call it, I call this crowdfunding for grown-ups. Kickstarter, people are committing dollars. There's no equity. They're doing it because they like the idea. They want to help a business, but there's no equity stake in these companies. All right, this is a totally, I don't know how many of you are aware of this. This is a totally different concept. All right, there's going to be, a fair amount of regulation around this. All right, and let me just, I think sometimes unfairly there's a lot of hype that you get. Let me even in our promo for the evening, if I could read it to you, right? It says, as a result of the new law, many of the previous restrictions on equity financing will be reduced, significantly expanding the opportunities for companies seeking funding at the critical early stages of their growth. Now, that's true. All right, I don't know how easy it's going to be it's going to be for companies unless you've taken the proper steps and done things in terms of governance and following rules and regulations that you're going to need to do in order to be able to go to the marketplace. All right, there happens to be another event this evening on crowdfunding that's being run by the Entrepreneur and Small Business Forum. Right, and they say, however, it appears that crowdfunding can essentially replace an initial round of angel funding, making successful firm launches more probable. Secondly, crowdfunding support makes startups more attractive to angels and venture capitalists, increasing the chances that they will qualify for additional rounds of financing from these sources down the road. All right, and to boot, significantly, the crowdfunding industry has already demonstrated an ability to attract considerable amounts of capital. As of mid-2012, one intermediary has raised over $200 million for new businesses. I don't know if they're referring. Maybe you know. I don't know who they're referring to, whether that's Kickstarter, but it's certainly not crowdfunding as as it's contemplated under the Jobs Act. All right. Just to give a little plug to myself, I wrote an article for the New Jersey Tech News, right? And the title of the article is "Easy Access to Capital," and underneath, "Not so fast." All right, all right. I don't know how many of you know, but if you want to raise between $500,000 and $1 million, all right, you're still going to need audited financial statements. All right, and I'll let Alex talk to that talk to that a little bit. All right. If any of you have been in business for a while, you're dealing with your accountants, you understand what's involved in an audited financial statement. I've seen articles out there which talk about being able to do audited financial statements and paying an accounting firm $5,000 to do an audit. Well, I don't know what type of an audit which is going to pass muster with the SEC. That anybody can do for $5,000, all right? So you understand, and the point that I'm trying to make is that you're going to have to register with the SEC. There are going to be funding portals, all right, which are going to be the mechanism through which you're going to be able to raise money, all right? And there are going to be a lot of strict requirements on those funding portals, all right? So understand that this is not going to be, I'm going to the internet and I'm going to be able to raise $1 million. It's not going to work that way. You gotta, I don't know. I don't know what companies are thinking because it's all so new. So I eagerly await to see where this is going where and how this is going to play out. I think it's a great concept. I hope it works, but myself, I'm very, very skeptical as to, in this context, in being able to raise equity in this way through the internet, whether or not it's going to work. So that's my take on it. All right. I'd like to hear a little bit from these gentlemen as to, what their take is. We have the investment merchant banker here, we have the accountant, we have the attorney, and from their viewpoint, what they're thinking in terms of, how this is actually going to work. So, Scott.
Thank you. We generally view this as an opportunity. We truly believe that it'll be an ability to supplement other capital raised. But we also think that you're still going to have to go through some of the same processes and procedures to attract investors versus attract people who are looking to get product that the company is actually making. So we think you still have some of the same corporate governance issues. We think you have some of the same audit requirements, some of the same structural issues, and some of the same valuation issues. We expect that investors who look to do crowdfunding will probably be more discriminating than those who are on Kickstart. And we would expect that the likelihood is they're going to look for someone to validate, to some extent, valuation, corporate governance, structure, those types of issues. A couple things to think about. Most small companies, when they start out, want to be LLCs. Just to clue you in, investors hate LLCs because they hate getting K-1s, they hate worrying about it, they hate having this passive income issue. So you're sort of kind of going to be forced into a C type of corporation, I think, for the most part. I'll leave it to the lawyers and the accountants to walk you through that. But a lot of small companies we see, they walk in the door and they say, well, we're an LLC and you got to stay as an LLC. It doesn't work. It's one of those non-starters. The second issue that we continually see when we see small companies is they have a misunderstanding of how things are valued in the marketplace and how risk is adjusted in the marketplace. And one of the hard things for most entrepreneurs is to try and value these small businesses. It's a very difficult process. And we think ultimately what's going to happen is either the portals are going to do it or some of the small brokerage firms are going to end up having to validate some of these issues so there's some comfort level for investors that they're making a rational investment and there's some ability to not feel like they're being cheated, because there's a huge opportunity for fraud in this kind of marketplace. The second issue we're very concerned about is, we always look at, after we do the first round of financing, where's the next round of financing going to actually come from? So you have to start thinking about how you position the company, not only for the initial $1 million that you think you're going to get from crowdfunding, but $1 million, I know it sounds terrible, doesn't last all that long in the business world, especially if you have a burn rate. We see a fair number of companies in the medical device area or the biologics area, and $1 million gets you nowhere. So you really have to think about, both from your standpoint as an entrepreneur, but as well as from an investor standpoint, if you get the first round, you got to be in a position to understand that you're going to hit a milestone where there's going to be some increase in valuation and some ability, in our view, to get the next round of financing. And then the third issue is, when you think about these small private companies, is how are investors going to get out? Most investors, when they invest, want to make money and get out at some point. So you have to think about either a liquidity event, whether it's a sale, whether it's an IPO, whether it's a recap. There has to be some plan that is rational and intelligent. Otherwise, investors are going to feel like they're stuck. So those are some of the things I don't think have been fully fleshed out. From our standpoint, the biggest change we think that the law is proposing is not necessarily crowdfunding. We think the elimination of the prohibition against advertising the sale of stock is the biggest change. The rules haven't been published, but in 30 years of being in this business, that's always been one of the biggest issues and one of the biggest problems is how do you get the word out about an offering? And we think if the SEC adopts rules that we think Congress wants them to, we think that's the real game changer. We think that changes the way capital gets raised. We actually think, to some extent, it disintermediates some of the smaller brokerage firms who have been involved in some of these smaller capital raises and lets the companies go directly to their constituencies and their investors without worrying about running afoul of some of the various rules. That's sort of our general thought. Yes, sir.
Sure.
Is that for any size of offering or just under the limit?
No, we think it's for any offering. The general solicitation rule, the elimination of it, we think, if we read the rule correctly, is going to eliminate the general solicitation rule. Yes, sir.
I always thought that was, you stop general solicitation for those if everybody's accredited.
No. No, you have the same problem in IPOs. I'll leave it to Sasha to sort of walk you through it, but you know, one of the problems we've always had is even when we're doing IPOs is the CEO says something off the cuff to someone in the press. You have an article in the Wall Street Journal, and now you have a general solicitation issue, and you got to slow the offering down, you have a gun jumping issue, all sorts of problems. So we think this eliminates a lot of those issues, and we think it also lets you go directly to your targeted audience, which you can target based upon the internet, and target based upon your customers, and target based upon your relationships, which is much harder to do in the current environment. So we think that's really where the big changes. There are other changes we see. There's some changes in how we think small cap stocks will be traded in the aftermarket, which we think will enhance the liquidity. That I think is for another discussion. But I think in general, that's where we see the big change. And we see the big opportunity for small companies to sort of streamline the capital formation process. And we think that's been a major problem over the last decade. It's been hard to raise capital for small companies.
Okay. Alex.
We think that the crowdfunding proposals as put forth by Congress is interesting, and I think we think it's good for small business. However, we are, thinking through what the SEC is going to do here, because I don't necessarily think that they're in favor of it. So it's going to be obviously the devil's in the details with how they do the rulemaking to conform to what Congress is telling them to do. So that remains to be seen. But we think it's a good idea, and it's a benefit to the small companies out there to need to raise funding. So really, obviously, the devil's going to be in the details with that rulemaking. So more to come on that. But what we're focused on, and we're going out and speaking to clients, it's relating to the emerging growth company designation and what that means, and allowing confidential filing with the SEC. We think that's important. We think that's big.
So this is
outside the crowdfunding.
I mean,
our focus has been, since there's not a lot of detail in the crowdfunding, and that's not something we're focused on, we've been out talking more about some of the other provisions of the JOB Act. And the confidentiality, I think, is a big one. Another big one is the financial statement requirements to go into a filing. There's reduced filing requirements, 2-year sets of financial statements. I think as said earlier, they still need to be audited. You're not required to comply with certain Sarbanes-Oxley Act requirements with auditor attestation of your internal controls, and you get a pass on your internal management attestation on internal controls for some time. We also think that the reduced disclosure requirements from an accounting standard perspective is important. Right now, there's not much change, because since the rules came out, there hasn't been any new accounting pronouncements that have come out. But in the future, as new accounting pronouncements come out, companies that qualify would still be able to follow the private company requirements for adopting accounting standards, which we think is important for these small-based companies, and I think that's something that they're going to look at to take advantage of. However, there still is going to be some required disclosures about, they qualify as an emerging growth company, what their policy is in following the private company requirements, and how over time that may have to transition to a full-blown, public flyer if they lose the emerging growth company status. So that's what we're out there talking about. It's not specifically focused on crowdfunding, because that, to me, that's really still an unknown until the SEC does some rulemaking on that, which has said they're supposed to do that by the end of the year. But who knows, with all the backlog that they have at the SEC, who knows if they're going to get to it by year end. So I guess more stay tuned on the crowdfunding, but we think that there's other parts of the JOB Act that's operational now. So, companies that are in registration post December 11, they can, apply a lot of these rules, which we think are a benefit.
Sasha.
You got a question?
Yeah, I guess, what's the drive behind the crowdfunding? Is it the Kickstarter effect, or is this the government's answer to Kickstarter's very exciting? Is something similar? I just want to understand the background, because I'm trying to think, even in our space, and I work in the intelligence and media stuff. I don't see, and then we deal with a lot of very brilliant guys, brilliant hackers. I don't see them going to the crowdfunding. I mean, it would be too complex. I don't know if you probably seen that when you were in Silicon Valley. Some of the guys, brilliant guys, I don't see them going to the crowdfunding model that's being proposed here. But I just want to know what was the precursor to that? What brought us to? What brought in the government to say, okay, let's go down this route?
I think, not to get into the legislative history of the Jobs Act, but I think what you're hitting on is the one thing about the crowdfunding piece that I actually am really excited about, which is the general concept of it. Beyond that, I'm in entire agreement with Alex and Scott. I think the fact that Congress took the time to set out some fairly transformative laws up and down the entire act, whether it's the EGC rules or relaxing the general solicitation or the attempted crowdfunding, I think it's sending a message that tech is critical, and because I think those are the companies most likely to be able, outside of crowdfunding, and I'll get to that when I talk about the crowdfunding piece, to take advantage of a lot of the provisions of the Jobs Act, and starting companies and growing companies is important to what's increasingly becoming a knowledge-based economy here in the United States. In terms of, I don't want people to leave here thinking that I think crowdfunding through the Jobs Act is a perfect thing. That by no means. I think it looks good that someone passed an act about crowdfunding. Beyond that, I don't think. I think there are significant problems with it for certain types of companies. There are certain types of companies, depending on what the laws look like, that this will be a great thing for. For the type of company that the three of us typically work with, a technology company, there are challenges. And there are challenges that revolve around the art of starting a high-tech growth technology company. And part of that is most successful technology companies, and there are notable exceptions, of course, are a successful partnership between entrepreneurs and investors. And I think your traditional investors, I'm not saying they're going to walk away from the greatest idea ever, because the company already has 525 stockholders who each hold, $2,500 worth of stock. But I think there is complexity with raising money through crowdfunding, creating a significant stockholder base of people that may not be as experienced with the incredible risk or incredible reward that it comes with investing in a startup company, and that alone can create a tremendous drain on a company. You have 100 stockholders, none of whom have invested in a tech startup before, and all of them calling and you asking every question you could possibly imagine. You're going to need an investor relations person as your third employee. That being said, I think that the companies that have been successful on Kickstarter, there is a clear type of company that it can be successful, and that's a company that typically would have a following already. Let's call it, a video game or a cool, hip consumer product. and they're pre-selling it. I think there are parallels to who might want to take advantage of crowdfunding, but I think your traditional two guys and an idea startup in technology, I don't think you want to preclude any type of fundraising, but I think there are likely ways to more quickly ramp and grow a business. But I think every fact pattern is going to be different.
Yeah.
Maybe we could get one of the panelists to take us through the legislation real fast and what sort of the high points are and what's still open for the SEC for the benefit of the
So maybe the private versus public aspect.
Say that again, the private versus
Public.
versus the public.
Well, I think, before going through it all, because I think Mike actually walked through most of the crowdfunding pieces of it, let me, and Paul time me, let's see if I can get through all of securities law in 45 seconds or less. Maybe give me 2 minutes. Michael, let's see if I can do my... So, and for those of you that know this already, I apologize. To sell stock in the U.S., you either need to be a public company with registered securities, or you need to have an exemption from such securities. There are a myriad of rules and regulations designed in both contexts to make sure that investors have enough information to make an investment decision, and various types of liability that will attach upon giving information that doesn't pan out. So the crowdfunding is designed to say, okay, you normally wouldn't be able to go out and raise this much money from everyone because it just doesn't work under the U.S. securities laws. And what happened is there were a bunch of regulations passed, and they said, the SEC, you have until December to figure this out. The SEC is, not riding the greatest run of publicity right now, and they're tasked with preventing or protecting us as investors. The American people call it, or the investing public. And I think what you're going to see from the crowdfunding is rules and regulations about how the portals may be set up, et cetera, that are designed in large part to make sure that investors have enough information to make an investment decision in the eyes of the SEC, securities lawyers, et cetera. And you can see the general ground rules like Mike laid out, which is audited financial statements. There's only so much money that each investor can actually put at risk in one of these companies. And on top of that, if you are making a material misstatement or omission, liability will attach in one of these crowdfunding. And to me, that piece right there is something that doesn't come across that clearly. That's a big deal. And selling stock to 200 people with that kind of liability, you really should make sure you have a sophisticated lawyer helping you out, or accountant, or something before you go down that path. But either way, it's got to be a wait and see until December.
Right. Understand that you're really, you're a public company. Your company is going to have to register with the SEC. All right, and there are specific requirements. I don't want to list every one of disclosure requirements and other information about your company in addition to the level of financial statements that I spoke about. The funding portal that we were talking about, that's the vehicle that you're going to raise the money through, has to be registered with the SEC. There are all kinds of requirements that they have to go through. All right, so you know, when you talk about the gentleman in the back, when you talk about public versus private, you know, even though there are, you know, the requirements are well reduced from a normal public company, there's still going to be a lot of burden on the back of your company to make sure that you're providing the proper information in the marketplace to protect the investing public. And by the way, the portals are going to have to get information about the investing public to make sure that, not that they're accredited investors, but I think if I remember correctly, in order to invest $2,000, you have to be able to show the portal that you make X amount of dollars. I don't know whether it's $50,000 or $100,000, but there, you know, as the numbers go up, your income requirement goes up. That's to be an investor in these companies, all right? So, you know, the thing that makes me so skeptical about this is that, you know, the poor young company here that thinks that they're going to be able to just, you know, go out and do it properly now, right? And I'm sure that's a whole nother topic in terms of, you know, whether this whole idea is going to be ripe for fraud and all those other things that go along with it. You know, there is going to be a burden on the company to allow them to go out into the marketplace to raise the money in this manner.
One of the other things that I thought was quite interesting, that's not well publicized in the Jobs Act, is for the first time in a while, Congress has told the SEC and FINRA that the research settlement that was imposed after the dot-com bubble burst is essentially void, or at least for the most part it's void. There's some question as to whether or not those who signed the settlement agreement, the big top 10 firms, are still stuck with it. But for the most part, the separation and the Chinese wall that exists between research and investment banking has been separated, and you no longer have to have that Chinese wall. And you no longer have to go through that same chaperoning process. For those of us that ran investment banking firms under that model, it became very, very difficult to run a capital markets business, because each time you had a company you wanted to talk to your research analyst, you had to chaperone them with either a partner from one of the major law firms or someone from like the general counsel's office. So we thought that was very interesting, and we're not quite sure how that happened, but it was a well-publicized spat at one point between FINRA and the New York Attorney General's office as to who would regulate research. And ultimately, the research settlement was signed by the Attorney General's office, and then FINRA had this rule sort of shoved down upon them. So that's gone, and we're not quite sure how it's going to work out, but we think it's quite interesting. Yes, thank you.
I just want to make an observation. It seems to me that venture has moved somewhat away from, you know, the two guys and an idea, and more moved up the chain some. And so it's difficult for firms or companies that are new to get funding between the $0 and $250,000 range. That's the most difficult, I think, those first monies. And that what I think is great about the crowdfunding is that might make that money, those first dollars, a little bit better, or a little bit easier to find.
By the way, the requirement, just so you know, to raise between $0 and $250,000, there's no financial statement requirement. Right. All you need to do, I think, is to post or disclose tax returns. So somebody has you know, some kind of information, you know, and can look at some numbers related to a company to see that they're real and that they file tax returns, you know, in the appropriate jurisdiction, you know, and then the financial statement requirements go up after that. So I may agree with you there that, you know, if you're looking to raise between $0 and $250,000, you know, and you have a nice company and it's a great idea, you know, real early stage seed funding, that, you know, that may be an avenue which will work. Sure.
If Scott, for example, you see a company and you say, you know, I like this company, and we're going to put our brand on this company, and this company can raise $250,000. Edco Capital will come in and they can hit some of their milestones have a proof of concept, then, you know, we'll put in $1 million a year from now. And, I mean, how do you think that can, people on the panel have been thinking about that?
Let me first answer your first question. Your first question is, you're absolutely right. The ability to raise that first $250,000 through crowdfunding would appear to be a much easier way than raising amounts past that 250. And just so you understand why it's become so hard to raise that seed capital, is if you look at the statistical performance of venture funds between 2004 and 2007, in those vintages, their returns in some cases are negative, and in some cases you would have been better off buying treasuries. So for all the tumbling about that you have to do to run a venture fund and lock up your capital, the return to the institutional investors and the pension funds and the endowments has been terrible. And obviously one of the reasons is it's been harder to get companies liquid or sold out of those venture portfolios. So from our standpoint, we typically see companies that already have some capital. We rarely see someone who comes in with an idea and 2 or 3 guys and a dog sitting in a garage. We tend to see guys who've gotten friends and family money, who have racked up their credit cards, have some proof of concept, and those are the kind of companies that we see, and those are the ones where we see the passion. We see the passion of the entrepreneurs, and a lot of what we back is the people. And it's very hard for an investor looking at over the internet to look across the table and someone look into the eye and see that passion, see that they will make sure this investment works. So I think that's one of the issues you're going to see. While I agree with you, it may help you in the short term, I think trying to raise $1 million in crowdfunding is going to cause you all sorts of problems. And when we then see those companies afterwards that have come in and they have 350 shareholders, and we have to start figuring out whether or not there's a problem, whether or not we can fix it, it becomes a counterproductive exercise, we think, at some point. Yes?
Just to follow up on that, do you think there's going to be any sort of chilling effect or counter negative impact because the initial investment won't have any strategic component to it, meaning that, you know, the investors won't be able to help the company grow in that critical first stage?
No, you know, we see that on a regular basis. We see where, you know, the first capital is put up by friends, or it's put up by family, or, as I said, credit cards, or they have relationships and found people to put capital up. We frequently find that they've overpriced the company in those circumstances, and you have this very awkward discussion where they've raised the first $1 million at a $15 million pre-money value, and the real value is $2.5 million, and now the poor guys who put the money in at a higher price, either they're going to get crushed and be very unhappy, or they're going to have to get adjusted so that they don't get crushed. So that's, I'm obviously exaggerating in terms of the valuation issues, but those come up on a regular basis, and it's a huge problem. We also see, quite frankly, a lot of times where how that offering was done leaves us nervous that there may be rescission rights hanging out there because they didn't do it properly. So we're sort of stuck trying to risk adjust whether or not there's a likelihood someone's going to sue for rescission, especially if they get crushed on valuation. So those are the kind of things we look at, both as an investor as well as an agent, because we do both. We sort of wear both hats depending upon the nature and extent of the transaction, the nature and extent of the cycle of the company.
A lot of this has been focused on tech startups that are, you know, I guess everybody's thinking down the road to go IPO or get bought by Facebook or something. But I kind of have 2 related questions. One is, have they clarified that it's only going to be equity, or can you raise debt this way? And secondly, you know, sort of thinking of the situation, I know there's one company out there that's already aiming at this market, but they're going to do solar projects. So in essence, you get an SPV out there and just raise the capital for the company, and then the equity holders can get paid back, you know, their preferred rate or their interest in its debt. And, you know, you don't have to worry about some of the other issues that you're talking about, like follow-on investors. But I haven't seen whether that's one of the things you're thinking about.
You know, I think it's a good question. I haven't looked at it in the debt angle in terms of, but again, you're capped in terms of raising debt, and if you thought having a bunch of equity investors who've never invested before is a a serious situation having debt investors who, don't understand about, going sideways with the company or anything like that. To me, I would think I would pause long and hard as any kind of startups before raising a real debt round, but and real, instead of a convertible debt round, but raising it from people I don't know and just seeing through a portal, I'll defer to these guys. I would be very nervous about it.
And in terms of subsequent rounds of investment, how big is the disincentive of having so many shareholders from an initial round of crowdfunding? How real is that as a potential problem?
So from my perspective, I think it's a nice to have. You have a great business, venture or other investors, people will invest and people will find a way to clean it up. I think there's certainly advantages to having a clean, simple capital structure going into raising institutional money. That being said, I've been at a startup, and at times, the one person who wants to give you a $1 million check is not there. And you've got to do what you've got to do in order to raise money. In an ideal world, if I had my choice between 100 investors who were all putting in $5,000 or one person who'd put in $500,000, I would want that one person who put in $500,000 because that's a person who has substantial skin in the game. It may not be for them, but that's a person you can call on. That's a person you can get advice from. That's a partner who's going to live and breathe with your company. I'm not so sure I want 100 of those all with $5,000. So.
And I guess what role do the investors also play? Because I've always seen, and for us, the investors become our biggest sales guys. They're our biggest champions. They refer us to people. To Sasha's point, in this model, what role will the investors play? Do they just receive funding from them and then if they disappear? You just have to meet the reporting requirements and move on.
This is just me. I think that the crowdfunding, the easiest thing is going to be for people who already have a following to take advantage of it, in whether it's a consumer products company or a video game company or whatever it may be. And, I think it's just, oh, that's cool. I got, whatever it is, World of Warcraft 18, and I got a chunk of that. And, I put in $500 and I'm going to tell people about it. But I don't think you're going to have the formal guidance that an experienced investor can give you. And if you do, I don't know how you're going to figure it out. You've got 300 stockholders. You don't have that much background. You're not going around sitting and meeting and talking to these people, which to me, it's a critical component of any startup, is a strong and vibrant partnership between the investor and the company's management team.
So in general, I would agree. I think for the most part, you're going to get passive investors through crowdfunding or through any of these portals until things go bad. Then you're going to get very unpassive investors. Just the way people tend to act in these types of situations. Or you'll get guys who at some point want to find a way out of their investment, and they'll call you and say, I put money in 18 months ago. I think it's worth a lot more. You want to buy it, or find me someone else who wants to own this. So I think that's when you start hearing from investors, is either when they want a liquidity event or when things don't go well.
What kind of due diligence is going to be required of the people who are running the portals? And is this going to be like a quicksand if it's a FINRA registered broker-dealer?
So, having wearing both hats, we have a registered broker-dealer as well. We're a little nervous about whether or not it makes sense to participate in the crowdfunding side of it, primarily because there's not enough money involved in it to take the risk, both reputationally and economically. We think, as I said before, where the real change occurs is if you can solicit for the much larger private placements with accredited investors, then we think it makes sense to perhaps spend the time, energy, and take the risk, both reputationally and economically, to do a larger private placement.
So
with-
just a different way to approach accredited investors.
Correct. That's the way we're,
Perhaps more efficient.
that's how we're sort of looking at it. Sasha, but I'll defer to you. I think you're still liable. You know, my sense is, you know, I don't want to see too many people get sued on $1 million private placement. There's just not enough involved for plaintiffs' lawyers to get involved for $1 million. It's more of a regulatory issue. It's been my experience with FINRA.
Yes, sir. Oh, I'm sorry.
I mean, I agree. I mean, I think a lot of your question is a very good question, and I think a lot of that's going to come out when the SEC starts laying down the law, so to speak.
Is it specifically going to be limited to new companies or small companies? What's to stop an established company from using crowdsourcing?
So I would say the things to stop an established company from using crowdsourcing are, and let's really pare down what we mean by an established company. You know, to me, an established company with relationships, with funding sources, et cetera, I don't think they would ever take advantage of it or open themselves up to proceeding down this road. It's too much management time, too much uncertainty, and just a hassle factor, quite frankly, for a truly established company. If you have a nice, again, I'll go back to the video game example because I think that is something that you can have a following of whatever version 1 of the game. Version 2, you can Angry Birds 2, so to speak. That's something, but I would say a lot of these companies that are truly established, it'd be interesting to see whether, one, they would go this route as opposed to going with a Kickstarter where they don't need to give away any equity. Two, whether they would want to go this route if there were other sources of capital available.
Okay. Poor Alex is sitting here. So is the accountant, and I feel for him. They're the last guy that anybody thinks about. So Alex, just kind of give the audience a feel for, from a compliance standpoint, all right, the issues that they're going to face. I was talking about, having audited financial statements. I wonder, whether the people who are dealing with startups understand, what's in, if you want to go out to the marketplace to raise between $500,000 and $1 million, what's involved. And just from a general compliance standpoint, because you really got to look at yourself as a public company, right, as to what the entrepreneur should be thinking about and readying himself for. So if it comes down to they want to use this form of funding, that they'll be ready to do it when the time comes.
Sure. If you meet the requirements that you need an audit, you need to make sure that you have your ducks in a row from a bookkeeping and financial perspective. In my experience dealing with a lot of the startups and the early stage companies, that's a challenge at times. So even before you start thinking about bringing a company in to do your audit, you need to make sure that you have your internal books and records up to speed first, and understand the GAAP rules on an accrual basis that's required under these laws. A lot of the early startups are on a cash basis of accounting, and a lot of times that's not going to fly. If
Does everybody understand the difference between
cash basis versus
and
accrual basis?
Do we have to, we can get into that. I don't know the level of people's understanding of accounting. So if you'd like to get,
Okay.
Yeah, we're good? Okay, so keep going.
So, your bookkeeping is important. The company is required to have an internal control environment, to be able to know what's in their numbers, to have either staff in-house that can do the bookkeeping or hire an external, outsourced provider to do that. But that is sort of the nuts and bolts of it first. And then bringing an auditor on top of it to audit the books and records. And obviously I was talking about independence before. The auditor can't do that bookkeeping for you and then audit it. I think some people misunderstand that at times as well. The auditor has to be independent and a third party that is opining on the truthfulness and completeness and accuracy of your financial statements. And I liken that to a lot of the startups and the early stage companies to a proctological exam. If you've never been through it before, believe me, I've audited, back in my early days, a lot of these early startups, and it's a painful process. So, you need to make sure you understand the process, because that just adds time on to, what your timeline is for funding, and make sure you understand the timeline and you understand what the regulatory requirements are going to be, once you press the button, hit that registration statement, because then you're going to have ongoing periodic filing requirements to comply with the SEC reporting. So it's not as simple as people make it sound, and there's a lot that goes into having your books and records audited. Sasha, you wanted to say something?
I actually used to be an auditor, and I was the one asking the questions, and it's still incredibly painful. And so the thing that, and I'm not putting E&Y or Mike on the spot here, but an audit isn't free, and it hasn't been for a while. And I think you're getting into, in $1 million raise, you're probably getting into percentage points in terms of deal costs as well, to try to get something like this done, and which is not something, listen, all of us service providers, we would be very happy if all deals were being talked about in the 1% to 5% range, and that would be great. But it's not something any one of us really want to have happen. If you're raising $1 million, no one wants to be spending $20,000 or more on trying to get books and records in shape for a company that's been either a mom and pop operation for years or what have you. So there's real costs here, and it's a time, it's a burden, and it's an actual out-of-pocket cost.
I'm wondering what you think the role of the portals are going to be. I've heard reports that something like 450 of these portals are popping up, and you see another one getting funded every day. And I'm wondering if you guys have thoughts on, are these going to be just service providers, or are they going to be doing something else? Are they going to be curating like Kickstarter does? If you have any views on that.
By the way, hold on. I'd like to, when you say all these portals are popping up, all right? I mean, I haven't seen them. All right, I'm looking for them, and I don't know, right now, I don't know where they are, all right? So if you know some, and anybody who does, I mean, it's early in the process. So I'm sure they're going to proliferate at some point, but I've yet to, I've heard a few names bandied around, but not all that much. So
yeah, there are a few that have been raising money,
right,
that I've seen, and then I know, especially in the New York startup scene, there are a couple that are everywhere. And so, I mean.
But are they complying? My question would be: are they complying with the promulgated rules and regulations that they have to go through? And that's what scares me about this whole thing, is that the SEC still doesn't have their hands around what the final regs are going to be, and yet you have these portals popping up. And what are they doing? Are they complying with? What are they complying with? I don't know yet. I don't know. Yes, sir.
Can you just talk a little bit about the requirements for a portal, and I mean, you said something that you have to go through a portal to raise money to do this, but
yeah.
So what does that mean, and what is a portal going to have to do to become a portal?
I can give you a few of the things that in fact, what I'm not all that familiar with, because that's not my side of the business. But I can certainly, if you can bear with me, I'll read, I'll read you exactly what some of the requirements are. Okay.
And while Michael's doing that, I think a lot of the portal stuff, and I hate to keep saying this, wait till Christmas, I feel, but I don't think it's, shame on me, but I don't think it's going to be December. I'm not sure anyone else up here thinks it's going to be December. We're still waiting on some things. Not that this is not important, but we're still waiting on other stuff that was supposedly done, 275 days ago. So I will say a lot of the nuts and bolts on these portals of, how technically they're set up and how they have to store information, what information they have to take, whether they need to be, how they need to be funded, all kinds of different things. There's some parameters in the rules, and Mike can talk you through that, but it's all going to come out with the SEC stuff.
Right. So let me read you, right? And those acting as the funding portal intermediary would need to take certain actions, among which, besides registration, so they have to be registered with the SEC, would be to, 1, provide disclosures, including those related to risks and other investor education materials, and ensure that investors review such disclosures, affirm risk of loss, and answer various questions relating to financial qualifications, take such measures to reduce risk of fraud, including but not limited to background and regulatory checks on directors, officers, and significant shareholders of issuers, make available to the SEC and to potential investors any information provided by the issuer to investors and intermediaries no later than 21 days prior to the first day on which securities are sold to any investor, make such effort as the SEC determines appropriate by rule to ensure that no investor in a 12-month period has purchased securities offered pursuant to this exemption that, in aggregate, from all issuers exceeds certain investment limits. So they're going to have to, there's going to be a lot of checks and balances and things that they're going to have to do to qualify as a, a qualified portal. If that answers, I mean, that's just, this was taken right out of the regs, all right? So, goodness knows.
Can I just have,
Sure.
Well, sort of a follow-up. I think at the last point you read there was, is there a limitation on how many companies like this you can participate in?
I think there's going to be a maximum that you can invest on an annual basis. Maybe not companies, right? But based on, and it's going to be based on, it's almost like an accredited investor test, right? You're going to have to prove to these portals that you have the ability to invest a certain amount of dollars in total in a 1-year period. And it's the same thing for the companies, right? The companies can raise up to $1 million per year. So every year you can go back to the well again to raise another $1 million. And there's going to be, there's going to be regulation and restriction.
Is there a cap? So if you wanted to be like a holding company of these companies, you couldn't do that?
I don't know the answer to that, right?
We have seen several people have come to us for funding to fund these portals, and our general reaction so far has been there's not enough information for us to make a rational investment decision as to whether or not a portal makes sense. And to a large extent, we think that the whole thing is being overhyped in terms of the effectiveness, the returns to investors in the portal. So we've been quite skeptical until, I think as Sasha says, until Christmas comes, and we don't believe Christmas. We sort of think maybe it's St. Patrick's Day comes and you get some green beer and some indication as to the nature and extent of what the real rules are going to be. So we've held off, and we think the way the process is going to start is I think some of the small registered brokerage firms who already have the infrastructure in place will probably start out in this business first, because we're not quite sure what the registration process is going to be for the portals.
And just so everyone gets this whole, and this will be the last we talk about it, hopefully, but this whole December thing, I mean, this is not speculation up here. The SEC has openly stated you haven't given us enough time, right? And so I think when a government agency comes out and says, hey, Congress, we understand that you've told us we need to do this by December 31st or whenever it is, that isn't enough time. I don't think anyone's holding their breath for the details to really get rolled out. Just so everyone knows, this isn't people, guessing up here. This is the head of the SEC coming out and saying this isn't enough time, because I think there's a real concern that this is going to become a fraud pool, so to speak, of all these companies raising money on an idea.
Yes, sir.
Is it conceivable?
Go ahead.
I mean, is it conceivable that the SEC is really not terribly enamored with this whole thing, that they could effectively bury it just by over-regulating it?
They have said they're not enamored with it.
Yeah.
They have clearly articulated it from time to time and tried to block the passage of the bill. So your guess is as good as ours as to what ultimately happens. We think there's some political will, especially from some of the East Coast politicians and the West Coast guys who were quite upset that the ability to raise capital has been severely hampered. What happens, we're not quite sure at the moment.
Could they bury it by just over-regulating it, or is that not?
You know, it's actually interesting. For the first time, when you read a statute and it says the SEC and FINRA shall not adopt a rule that prohibits the following, there's pretty clear direction. But Sasha's right. The chairperson of the SEC was not enamored with the legislation to start with, and has publicly stated that they don't have enough time to adequately risk assess the risk of fraud versus the chilling effect on raising capital.
And in all due deference to the SEC, I mean, there are risks here, right? And there are the entire way that people have come to evaluate U.S. companies and invest or not invest in them is making sure there's enough information out there, et cetera, and making sure the right people or the right people in the eyes of the law, people who can take this kind of loss of investment are investing. So, the laws are out there. There's political backing behind them, but there is also a group of people who's going to have to deal with them that are worried, and not just about, oh, I don't want to deal with this or it's too complicated. There are real concerns about how to implement this in a way that satisfies the SEC's mandate, but also satisfies what the Jobs Act calls for.
This gentleman had a question.
I just kind of already commented a little bit about it. Do you think that in an election year, this is more political than practical?
It's hard for us who are not politicians to fully assess the nature and extent of the political pressure that comes to bear.
And with that answer, Scott's running for mayor next year.
I'm just running. We've had conversations with some of the senators who have been quite actively involved in this legislation, and they continue to want to have a dialogue. They want to talk about some of the market issues and the market structure issues, that because effectively you have a busted trading system for microcap stocks at the moment. So, in order to have a true capital market, you have to be able to invest, liquefy, and have people buy in the aftermarket. We don't really know what's going to happen. We can't predict the election. We think there's a whole bunch of problems they have to deal with in Congress before December 31st. There's some tax cuts that go away. There's some spending cuts that kick in on an automatic basis. There's a bunch of things that they have to deal with. My guess is, if I'm speculating, that this probably falls to the bottom end of those major issues, because everyone is predicting if they don't fix the cliff, you're going to have a recession. It's pretty clear. So I'm not sure if that answers the question. I don't really know, but I am running for something.
Yes, sir.
I think I can add something that I think that the Obama administration is, does like crowdfunding and has come out in favor of it, but the real political will is what Scott talked about, which was the change in paradigm shift from no solicitation to allowing general solicitation, making this definition of emerging companies, increasing the number of shareholders you can have in a company before you have to go public. I think the political will and the wins are behind those provisions, and I think crowdfunding kind of snuck along with it. And I'm going to ask one final question, which is, and it's to the whole panel. I mean, given all these hurdles, pitfalls, difficulties that will stop companies as well as portals, if they are all handled and they are surmounted, don't you think that there will be a major change in how to start up a business if you could raise $250,000 each year from your group of friends or people that you know, from your circle of people. I mean, don't you think that that would be a major shift in the startup world, or am I wrong?
I'll take the first shot at that. I'm optimistic. You can't be in this business and invest in early stage companies and work with entrepreneurs if you don't believe in the future. And we tend to think that we've had a very painful 4.5 years or 5 years. Pick the number you want to pick as being painful. And we're hoping that when you get past this next election cycle, the world will start getting more rational. I don't necessarily think being able to raise $250,000 changes the dynamics of the small kind of businesses we look at. We don't think it's enough. We don't think it gets you far enough along. But we do think that the ideas that are expressed in the Jobs Act and the political will to fix what is clearly a broken capital market system is in the right direction. And we do think eventually we're going to get there. It's going to take a lot longer than we'd like it to. Some of us are going to get smacked around by it. We're going to make mistakes, because that's the nature of what happens when you invest in early stage stuff. But to a large extent, we think it's heading in a positive direction. And for the first time in 20 some odd years or 30 years that I've been engaged in this business, we see the federal government recognizing that they've overregulated the industry. And we think that's a positive. So I'm optimistic.
Yeah, we think it's only can be a benefit to these small companies that need, that amount of capital, and we're hopeful that the SEC will do what it needs to do to pass the rulemaking and allow the crowdfunding to go through, so these companies can access those funds and hopefully grow into a company that benefits the economy and can grow jobs and everything else. Because after all, that's what it's all about, growing the economy and growing jobs.
Yeah, like I said, I think I share both Scott and Alex's thoughts that the ideas behind it, the recognition, the fact that it was passed, that's incredibly powerful. And I think it remains to be seen how it plays out, and for what type of companies. And I think that's where it really, I think it's going to be very vertically, if you end up looking at a bell curve in 20 years, I think you're going to be looking at certain segments that this really works well for, and other segments it doesn't. It's like all markets.
Yes, sir. One last question. I think we've, it's 7:45. The heat is, I think the heat has got all us, and maybe you want to get home to see the heat too, so, if you're a basketball fan. So let's just take a few more questions and wrap it up. Yes, sir.
So this follows up a little bit on the last question, but moves a little bit away from crowdfunding as well. I believe one part of the Jobs Act is the removal of the general solicitation provisions for offerings that are just to accredited investors, that those rules are supposed to come out within 90 days of April 5th. Do you on the panel have any sense of kind of if that's happening, if that's moving ahead, or if the SEC is kind of slowing that process down as well?
So, and I hopefully, because I do need to practice with the SEC, I don't think they're intentionally slow rolling stuff in any way. I think there's complicated issues, and but I don't think any of this is coming out on time.
We would be shocked if it came out on time. Absolutely shocked.
Anybody else?
Yeah.
Yes, sir.
I think, Sasha, you said that a clean and simple capital structure could go a long way towards minimizing the fear that a second round of investors might have towards a company that raised, let's say, $250,000 from crowdfunding. I'm wondering if anyone on the panel could give any specific advice, do's or don'ts, towards simplifying capital structure.
So I would say a couple things. Keep it simple. Keep it straightforward. There is a tried and true way of raising money at this stage. And I don't know, I wouldn't try to reinvent the wheel. And, you know, if there are investors here, I apologize. I would say, you know, avoid these kind of anti-dilution clauses that you see from at early stages sometimes of I'm putting in $20,000, I want 5% ad forever. You know, so if you can avoid that.
All right, thank you all for coming. I hope you you took away a lot from this, and please, absolutely, you know, come back and you know, take advantage of what, you know, we as the New York Technology Council, you know, are trying to do and help the technology community here in New York. Paul, would you like to say anything else?
Yeah, just thanks to the panel. Let's have a big round of applause. And to Mike for putting this together. If anyone would like to go be on the mailing list for future legal and finance events, please leave a card with Mike or me or with Alice on your way out. And we hope to see you at another event soon. Thanks very much.
Let me make one final remark. Paul mentioned that advocacy is part of what we do. We were down in Washington lobbying for the Jobs Act, so we were a small part of this process. And obviously, since this is in play and work not yet finished, we'll come back with another event to bring you up to date on things as they evolve.
That'd be great. Yeah, absolutely. Definitely. I don't know if I gave you my card.